Welcome to this week's Mortgage Moment. Hi, this is J. Michael Seeley from Demystifying Mortgage Loans. And this week, we're going to expand upon what we talked about last time, where we're talking about the strategies if you're facing increased payments or mortgage defaults or foreclosure. Now, that could be due to a loss of a job, a divorce, unexpected medical bills, or investment collapse. But most often it comes due to payment shock. So how and where does payment shock emerge from? What happens when your mortgage payment jumps dramatically? Almost always due to an adjustable rate mortgage, either jumping from a fixed rate, readjusting in its periodic readjustment, or a recast, and that's often associated with option arms. Now again, adjustable rate mortgages and option arms are terrific loans if properly explained, understood, and monitored. So let's take a look and see what we were told and what we should have been told when we got that adjustable rate mortgage. Well, we probably were shown a 30-year fixed rate at, say, 6.5% interest with a payment of almost $1,900. This is based on a $300,000 loan. And that would have been the same payment for 30 years. But that's a little bit higher than we could afford, or we wanted to afford. So we're probably shown a payment, how would you like one, around $1,300. And their interest rate would be 3.5%. And that would be good for 36 months. And they could have chosen 24 months, or 5 years, or 7 years. All adjustable rate mortgages. But we took the 36-month adjustable rate mortgage, fixed for 36 months. Well, that was easy to see. A $1,300 a month payment was a lot more favorable than a $1,900 a month payment. So does the payment continue, or does it stay at the same start rate? Well, that's a good question. And that's a question that should have been asked 3 years ago. What happens at the 37th month? Does the payment stay the same at $1,347 a month? Does it drop? What does it do? That's a question that should have been answered by your mortgage professional, pointing out that the rate would change and pointing out that you may want to refinance that time. Perhaps you will sell the property, but to be aware of when that 37th month hits that there will be a change in your payment and likely upward. That's where understanding your loan up front with a mortgage professional and having a monitoring system watching your adjustable rate is critical to your future financial status. Because when the adjustable rate converts from its fixed portion into its adjustable rate, it will probably balloon up considerably. Remember, the adjustable rate mortgage rate is the current index plus your selected margin, as long as it doesn't exceed the cap. As you can see here, this could be as high as than $2,577, almost twice what it was at the start rate. And that is payment shock. This is what could lead to default payments or foreclosure. As you can see, a simple doubling of your payment can be rather shocking. Now, does that mean an ARM is a bad loan? No. There are purposes for short-term ARMs, like a lower payment versus the higher payment of the 30-year fixed. Just be aware of what can happen down in the 37th month, or if it's the 5th year, the 7th year, or whenever your fixed rate converts into an adjustable rate. And just remember to be aware of the conversion date when it goes from a fixed to an adjustable rate, your ARM caps, which we talked about in an earlier mortgage moment, and what can initiate recasting, which is generally associated with an option ARM. Well, what do you do if you simply can't make your mortgage payments? We touched on that briefly last week, and we'll go into more detail that on the next mortgage moment. Again, if you have any questions about today's show, go to askyourloanquestion.com. And for a complete demystifying mortgage course, go to yourloangenie.com. Thanks again. This is Mike Seeley, and we'll see you on the next mortgage moment.